the market in 2022 did not necessarily like mergers and acquisitions. 2021 was a record year. 2022, not so much. We welcome now somebody who's a true expert in mergers and acquisitions. He's Bill Curtin, head of mergers and acquisitions at Hogan Lovells. So welcome back. Great to have you here, Bill.
David, it's great to be back with you.
So go back in history just a little bit before we go forward. As I say, 2021 was a record year, shooting the lights out. 2022 struggled a bit.
You have it exactly right. 2022 was a dose of reality check after a frenetic 2021. 2021, keep in mind, was not like anything we'd ever seen, both in terms of aggregate transaction value and also the number of transactions that were accomplished in 21. The thing I like to remind people, David, though, is 2022, while a bit of a reality check, still exceeds in volume of transactions and aggregate transaction value the last 20 years other than 2021.
Oh, is that right? I didn't know that.
So even though we've come down dramatically in the second half of 2022, and we have, I mean, you can see all the slopes in the charts, as you mentioned, David, they came down quite a bit in the back end of 22, particularly in the technology sector. We still have a performance in M&A that augurs pretty well going forward.
That's interesting because technology also, as stock values, did not do very well in 2022. Do those often track one another?
They do, because it's all about executive suite confidence. So it's very psychological, M&A. Of course, cost of capital is important. Of course, the regulatory dynamic is important as well, and sort of the general economic conditions that we face. But at the end of the day, executives in the C-suite are looking to their left and they're looking to their right. And they're thinking about what their competitors are doing. They're conscious of what their stakeholders expect them to be accomplishing. And they're very mindful of where they want their companies to be going. So there's a lot of subjective, soft elements to what drives M&A.
You mentioned cost of capital, and I was going to ask about the Fed and interest rates, which have to be a factor, obviously. How much have they been a factor in 2022, and how does it carry over into 2023?
Very significantly. What the Fed has done in 2022 really put yellow lights and brakes on all the momentum that we had coming out of 2021. Think about what happened to us in the United States. We're a country of extremes, and we generate 50% of global M&A around the world, right? So we moved our way through the pandemic, and it was really tough for us at the front end. It was extreme, right? But then we were quite nimble. In a sense, the pandemic to me was an M&A event, right? It was non-organic. It wasn't anticipated, and it certainly wasn't a straight line. And we moved our way through, and we moved through with so much heat and so much intensity in the marketplace that, of course, it drove us into an inflationary state and potentially recessive economies. The Fed had to react. The question was, did they overreact? Did they react quickly enough? How did they modulate their reactions? And what do we expect for 23 going forward? I think there will be a bit of a drag, David, on the front half of 23 because of the Fed's interventions, needed as they were. And I think on the back half of 23, you're going to start to see M&A recover and lift even more.
So uncertainty is a big enemy of mergers and acquisitions, as I understand it. At the same time, as you look at prospects for mergers and acquisitions, to what extent is the financing even available, even at a higher price?
Yeah, the cost of capital has increased, no question about it. On the other side, what's very interesting is the valuations and the cost of actually acquiring the targets has decreased, right? So I love the way Abigail was describing the capital markets in your last segment, which is, tougher sledding right now. No Santa Claus rally, right? Tougher sledding, but opportunistic, right, looking forward. And that's what I see for M&A. So private equity now accounts for almost 1/3 of the transactions that occur in the marketplace globally now. And they are shrewd and astute, and they are looking for their opportunities as valuations decrease going forward to snatch up some really wonderful assets in the marketplace.
And do they have a lot of money to deploy, as they say, dry powder?
Tremendous amounts of dry powder stockpiled from the excesses of the capital markets and the liquidity experiences they've had. Remember, 2021 generated for them tremendous returns in investment in private equity. Those sponsors are lined up, and they're watching life sciences, healthcare, they're watching technology, they're watching the energy and natural resources spaces. And I expect in the back half of 23, you're going to see some really significant and shrewd deal making by the sponsor side of the community. And I think the strategics will do the same as well. If you look at the automakers, for example, if you look at the Mustang, the Mach-E technology, right, which is an electric vehicle now, right? And you think about what Ford's looking at, right? 60% of the purchases of Mach-E Mustang technology of cars were from folks who owned other brands of vehicles. So if you're Jim Farley and you look at that, you're thinking, wow, what an opportunity I have to move people who are loyal to another brand over to my brand because my technology is moving forward. And that technology advance depends on M&A.
Are you having clients call you up and say, look, I've been looking at that company for a long time, couldn't afford it, now I can because the price is lower?
Absolutely. And they're saying, let's move quickly because there's less of an auction mentality in the marketplace. 2021, the valuations were so high, David, and the auctions were so competitive. Now things have abated. And as I said, we've come back to a bit of reality. And so buyers have an opportunity to engage in bilateral transactions. They don't have to compete against 11 other bidders. And they have lower valuations. Yes, the cost of capital is higher, but they can quantify that into their purchase price and still execute a very successful transaction.
So let me put you on the spot and talk politics with you as a lawyer, okay? In this limited sense, we now have a split Congress.
Yes.
We've got Republicans in the majority in the House, Democrats in the Senate. Does that help the C-suite? Because that means that Congress is probably going to be less active. We were talking about certainty being the most important thing.
I actually see it exactly that same way. I don't believe that so-called gridlock or the bipartisan circumstances that we face are negatives for M&A. Predictability is the key. We got through those 2022 midterms, and we got through them with some decent clarity, right? We didn't have a lot of election contests out of that process, and we know where we're going forward now. We have the Inflation Reduction Act. We have Biden's infrastructure plan. All of that is settling now, David, and that puts C-suite leaders in a position of understanding predictability as long as they can figure out the antitrust.
Well, I was just going to say, take the other side of the trade, because when you talk about predictability, I'm not sure we have that in antitrust right now because the Biden administration says they want to change all the rules.
Watch the first quarter of 2023, and I'd love to come back and talk to you about it again, David, because watch the first quarter. The FTC and the DOJ have already announced that they are going to put in place new measures about what they deem to be unfair competition. This is beyond the Sherman Act. This is beyond the Clayton Act. This is where they could see, for example, private equity firms serially acquiring businesses that are underneath the thresholds for reporting requirements, but the FTC and the DOJ think that they're anti-competitive in their accumulations.
So this is a great point. You put together that 1/3 of the M&A comes out of private equity with the fact that the administration has been very explicit. We think there's shenanigans going on, my word, not theirs, in private equity. You could really put a freeze on a lot of M&A deals.
Think about this. In Europe, they actually have a name for this. The antitrust regulators in Europe call them killer transactions. Killer transactions are technology companies that come into Europe and buy up smaller companies before those companies can become meaningful competitors and threats. So you look at the European authorities now, and they're looking at Microsoft bundling the Teams technology with the Outlook technology and not liking that very much, right? And so they're watching these big, powerful tech companies that drive a lot of M&A and a lot of capital markets rewards and looking at them quite suspiciously, David.
I'm going to try to sneak in one last question. As you look at your M&A practice, is Europe, the European regulators, or the American regulators, when it comes to competition and antitrust, the bigger problem for you?
There's a term now called the Brussels effect.
Really?
There's a term that's emerged in the practice of M&A called the Brussels effect, which is watching what comes out of Brussels and the European Union and seeing the impact it has on the FTC and the DOJ. And I do believe you've put your finger on a very important point. We cannot just live in the narrow confines of the U.S. regulators. We have to watch what the Europeans do and how they impact the way of thought here in the United States.
It's fascinating as an old antitrust lawyer to think of us following Europe instead of the other way around, because for many years it was the other way around.
You're quite right.
It's fascinating. Thank you so much. Really great to have you with this, Bill. This is Bill Curtin of Hogan Lovells.